All right. Good morning, everybody. So we're back at it. Do it again. Should be a fairly quiet week to at least to start things off. We have FOMC. For the most part, we're not expecting much out of them, right? That'll be Wednesday. We'll have Thursday off. So we'll see what we get. Looking around this morning, not a lot going on. War vibes gave energy a little boost last week, but it's not sticking around. Small caps at 1% this morning, outrunning or outperforming the NASDAQ, the S&P, and the Dow. Japan is basically flat with Hong Kong. And Europe, it's a bit mixed, 0.5%. Manufacturing survey, and they're just asking them how they feel, right? The warm, fuzzy feeling surveys don't really carry a lot of impact, but it's looking to improve, right? From a -9 to a -6. It sounds good. We've seen earlier in the year when we were looking at a lot of these surveys, they were getting political and actually asking people, what party are you in? And then where do you think things are going? And that's try to just keep politics out of your market insights, right? It's going to help you out quite a bit. So when it comes to these surveys, just take them with a grain of salt. Either way, though, the numbers are looking to improve a little bit. We're not expecting anything out of that. Because of the short week, it's going to mess with the crude and nat gas data. So we would expect nat gas to be on Wednesday this week with the crude oil inventories. We have the 20-year bond auction. We're not supposed to have favorites when it comes to our children, or our pets, but I sure do like that 20-year bond. And then we've got some bonds in the front end, the 3-month and the 6-month auctions. So you could probably just watch the IRX on that one. 13-week, it's close. Overnight tonight, we're going to hear from the BOJ, Bank of Japan. It's very likely we're not going to get any new information there, but they have already signaled that they're not looking to make any changes. And the last I heard, they were still going to taper the pace of their bond purchases. We'll see. It's a quiet Monday, yo. We are on the new contracts. So unless you manually roll, most brokers should have already done it. The odd thing is, this is the first time in a long time that we've come in on a Monday of the week of the roll, and the volume had not already exceeded the previous contract. I can't remember the last time we had this, right? It's not really much of a tell for anything. It just stands out as a little bit of an oddity. It's like they're either late to the game and they're just not getting it moved. Like they're holding on to those previous contracts just a little bit longer than they normally would. Either way, it's a bit of an oddity, and I don't have a why behind it. As for where we're going in the new contracts, it's lower, which does stand out for the next quarter, right? I've often said, just think about what the S&P futures are, right? And what it is representing. Where's the S&P, the SPX going to be in September? Higher or lower? Just look at the futures, right? This is calling for lower by 50 points. Just, kind of chew on that a little bit. Volume's a bit light, all things considered. It is OPEX week, triple witch. We're going to see all sorts of shenanigans when it comes to volume this week because of that rolling. This is odd volume that really screws with newer traders. When you're new to trading, they tell you focus on volume. It's so important. And then they don't really get into the weeds for those new traders to explain the difference between a rolling activity and just new position activity. So this is going to show up as volume or as transaction and trades, but it's not really new positioning, right? It's just an existing position that's getting kicked down the road, good or bad. Either way, it's what we got. So we're a little light. And if you've ever heard me talk about the market maker move, you're going to see it a lot this week. It does not mean that they're getting any additional hedging in. You'll see it because it's the function of how it performs, and it's just the idea that they're rolling, and they're rolling out of those front expiring contracts, and that activity can activate a market maker move. So it's going to be a false signal through most of the week. And unfortunately, we know on FOMC day, they're going to be running additional hedges, but we won't be able to distinguish between that and just the role dynamics of them changing contracts anyways. So for the entire week, when and if you see the market maker move, just discount it or ignore it. It's not going to be helpful. Just the way it is. We're working on an inside day breakout with Friday. If we're just looking at the RTH, then we already got it. But if you look at all of Friday, including its Globex movements, we're not quite there yet. And when we get there, if we just run it out here onto the daily, every time we've been above Friday's highest point, we've been rejected. Four times in a row, right? Maybe the fifth time is a charm, maybe. On the highest one here from the 11th, we took a pretty solid rejection all the way back down to 59.50, but we are right back up again. When it comes to rejections like this, how we reject and what price does afterwards matters a lot, right? It's like the old adage of getting knocked down. Everybody gets knocked down. It's how you get back up that matters, right? So when it comes to these rejections and the way price fades back away from a rejection, how far it goes, how quickly it stabilizes, and then how soon it gets back to retest the previous zone. That's what comes into play. So all things considered, we recovered relatively quickly from the rejection that we took, and we're running right back up there to do it again. So we need it to play out, obviously, but if we don't set a newer high here, it is much more likely that we set a lower low here. If we set a higher high, then all things considered, we're more likely to get another higher low. We'll just use Friday's bar, set out the 111 and the 1236. $60.80 and $60.95 is what we end up with. $61.55 is the call wall. We're still a long ways from that. We are back above the 10, the 4. We're back above all the moving averages. There's that market maker move we were talking about. Just ignore it, right? Even if it is a true market maker move, we wouldn't know because of all the rolling in the front end. We've already got to the ADR half. Generally speaking, if we get to one edge early enough, we can go to the other edge by the end of the day. But we got there and we kept going. So now we've got to resolve these two. And it's very likely that we just stay in this range. It's a 40-point range. But for a Monday without a lot of data, we can do it. It's not going to be much fun if that's what we do. So maybe shop around a little bit. Look at copper, gold, oil. If you're trading futures, one of those may be a much more viable opportunity. Commodities. And or get out of this range. So if we can get above 60.81, we should have a straight shot into 6,100. And if we can get back below the ADR half on the downside, then level by level, I would target Friday's RTH open and then the RTH low. Then the Globex low, level by level. And of course, along the way, you would get to the ADR half on the downside. So that logic of the ADR getting there early enough, we have to break it first before we can start focusing on the other side, level by level. This is the first time in a while that our average daily range is anywhere remotely close to the one standard deviation. It's been a long time. And it's still not there perfectly yet, but we're at 80.5 versus, call it 74. Showing that we're getting back into a normalized state. We're not there yet. We're moving in the right direction. The thing about volatility, even though we know this statement isn't true, it's what they say. And generally speaking, it's the way the world works, right? When volatility is low, they say it has nowhere to go but up. We know that's not true, right? Volatility can just stay low and or it can go lower. That makes sense, right? And when volatility is high, they say, well, it's high, it has nowhere to go but down. And that's not true. We know it can stay high, it can go higher, but generally speaking, what goes up must come down. And this disparity between the ADR and the one standard deviation, right now we're in like a low vol environment. It might not feel like it, right? It certainly doesn't feel like it out there. But think of volatility from the nerd word. Volatility is movement, pure and simple. So a lack of volatility is a lack of movement, or reduced volatility is reduced movement. Yeah, pretty simple. Implied is promised. So you take implied volatility, you have promised movement. And if you're reducing your implied volatility, then you've got a reduced promised movement. So when you just get rid of all the fancy talk and put it into plain English, we're not moving as much. And the expectations of the market is that we're not going to continue to move as much, that we're reducing things. So when volatility is low, it has nowhere to go but up. What the old adage is anyways. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. But as soon as we opened, we ripped right through it and we've left it behind. We are above the weekly pivot, which is bullish in the bigger picture. And today's channel is it's more narrow than yesterday's channel. It's not as narrow as it could be, but it is a narrower channel. And a narrow channel implies that if we break out, it can stick and we can continue to run in that breakout. Just keep in mind, these channels don't make price do anything. They won't make us break out. They won't make breakouts fail and bring us back in. They just give us insight on what to expect if we did break out. But one thing that we really want to keep track of on a day like this are the S&R levels. So we've already had a pretty good run. So you can see we're at S1. We're at R1. The idea behind how wide today's levels are is based on how far we moved on Friday. Everything is connected, right? If Friday had been a narrow range day without a lot of movement, today's pivot levels would be a lot closer together. But we ranged quite a bit on Friday, so we have spread out levels today. And there's a pivot point trade strategy that focuses on getting onto an R1 with a target at S2. And we're there. We got that. We got the R1 already. Of course, you could play the game the other way around. If we were at the S1, then we would target the R2. But it hasn't left after it got there. If it was going to do that, much like when we got to the ADR half, we would have turned around already and we would have gone in the other direction. We didn't do that. We got there, we tested it out, and after a brief pullback, we are right back up against it. On this time frame, if you look at how we've been reacting at this level, it is the line in the sand that we need to get through. So if we do break our own Globex high and continue to the upside, we have an R2 level up there. It's not unheard of for a market to just continue in one direction all the way to an R2 or an S2. We can see on Friday, for an example, we cut through the floor pivot and we went through S1 like it wasn't even there, and S2, and we continued to fade all the way into the weekly pivot point before we ran all the way back up to the floor pivot, and then all the way back down to the S2 again. If we lose this floor pivot, play the levels back down to the floor pivot, that'll get us back to basically where we opened last night, and we can reevaluate. If we get underneath the weekly floor pivot, we can target the S1 down here. So we've been piling up against this high for a while. We've got a pretty solid distribution here, and we are nearing the top of that structure. So if we can get out of the box, basically the entire value area here, the value area high and value area low, get out of that box, and we've got a nice shot to the upside. We could focus on reciprocation at first, just getting whatever we got on the downside to the upside. Or we could measure the entire thing and project those levels higher. If we focus on reciprocation, that puts us 6150-ish. And we're talking about how far we moved in a week. So that's not today's level. Ten-day, 30-minute volume profile and TPO. The point of control on both match. Wiping out candles on the left is going to reduce the size of this thing. So by Wednesday, if we haven't broke below 59.50, we'll have a much narrower range, 150 points from 6,100 down to 59.50. Not as narrow as we've seen, in the past. We've gotten it lower than this, but it's narrow enough. Now we got to get out of the box, and that's what we've been struggling to do now for a while. So GTFO, we have to get out of this range. We're above the point of control. We want to keep it. We've got the value area overhead, 6170-ish. It's basically the top of that range that we continue to reject against. And it doesn't look like we're going to see a change in where these levels are anytime soon, right? This point of control is not moving for at least a couple days like we talked about last week. Got a little discrepancy between the TPO's point of control and the volume profile's point of control this morning. Look for that TPO to get moved up and for the value area on the TPO to shift up to the new location. Got a new VPOC level. Basically 6,000. The reason for the color change, we're right in that time period where we're going to be shifting into new contracts. And while all the textbooks like to talk about carrying forward the profile and marking out the value area high and low, they don't really do a good job talking about things that have expiring contracts like futures. All those books and everything that are on profiles, Now, most of them are antiquated things that don't focus on the modern stuff we trade, like futures. So over the years, we've been marking these untouched points of control. And then the question starts to come in, well, does it matter if you mark, untouched points of control in a product whose contract has expired, right? Kind of goes back to the logic of, well, why are we marking the level in the first place? Because it's an area of interest. The idea is that's the greatest amount of trading volume that took place on that day. And there could be some trader's remorse if we go back to that level. But if those contracts don't even exist anymore, then is there any expectation that they're going to have, some impact if we did go back to that level? What I found over the years is that the answer is no, for the most part. I mean, it depends on how old they are, but if they are from April and we're not even using that contract anymore, it's very likely that there's no trader's remorse there. There's no expectation that that high volume node still has any impact on us if we were to get back there. So we'll see, right? We're in the new contract series. That's what matters. These old ones will very likely be taken off the board. Now, the textbooks don't mention any of that. They just say carry forward the VPOC. Well, the VOC, really, they don't even care if it's been hit or not. You do you. It is worth noting that the VPOC from Friday, or the POC, we didn't mark it because it had a candle that went through it right at the open at 6 o'clock that night. But that's the only spot we hit it, and we were there for a moment. And if we think about how much trading activity there was throughout that entire day, it lasted more than a moment, right? It was traders through the entire day. So that level should probably still be marked. Even if we wouldn't call it a VPOC, it would certainly still be an area of interest. And we can kind of see that this morning because that's where we were hitting, and we were having a real hard time getting through there. All of that was from the Globex. A lot of it is in the European session. If we go back there in today's RTH session, when the market's open in regular trading hours, it's very likely we're going to see more trading activity at that level. So I would put that one on the radar today. All right, this weekly indicator that we use, developed by Mobius years ago, it does a really good job most of the time, right? It's better than nothing when you consider that if you wanted to look at the weekly expected move in a watch list of stocks and different equities and products, that you would have to hand draw the lines for every single one of those. And it'd be a nightmare. So from that point of view, it's great. But every once in a while, this thing gets a little wonky, especially at contract changes. So here we are this week with a broken expected move indicator for a number of reasons. If it's a short week, sometimes this thing acts goofy, and it's a short week. And then contract changes like this week, it can act a little goofy too. If we look at the last contract change, which was right here, that very next week also had some screwed up settings. So, even this one back here, same thing. It happens. You can use Thinkorswim's Think Back. It's not their on demand, because that on demand is trash. It's Think Back. It's something different than the on demand. You can use that. Go back to Friday after the close. Get the expected move for the week and hand draw the levels. If you're using it on the SPX, it should be fine because it won't update until the market opens anyways, or it shouldn't. But if not, the SPX hasn't moved yet, should have the opportunity to do the same. Okay. I'll get them drawn out and shared in the chat so that if you don't have Thinkorswim and you can't go back to Friday after the close, I'll get the levels. The main thing is just recognizing that the indicator is broken for this week, so you don't want to use it. And you know, it's just the way it is. Nothing works all the time. We're still more than 3% above the 10-week. We're in a good spot. This is healthy. It's fine. There's nothing wrong with where we are. We haven't moved too far, too fast. It doesn't owe us any sort of pullback or mean reversion. There's nothing at risk here. This is just a good place to be, all things considered. So we came up into this resistance level in a healthy market positioning. You know, it's just if we had got into this level after being extended, well, that would be, you know, a cause for concern, but we're in a good place. Looking at the 10-day, it's kind of the same deal. We're not up more than 1% away from the 10-day. That's a good place to be. Sure, we're up a little bit, but we're not overextended. We haven't moved too far, too fast, and it doesn't owe us any sort of mean reversion. So we're just in a good, healthy spot. This is the zone. This is the zone we tend to hang out in good times. So we're there. We can expand out of it from time to time a little bit. I'm just peeking outside the level. But for the most part, this is like cruising on the interstate with the cruise control on. Nothing extreme, nothing wild, no sharp, crazy turns. There's been some talk about, you know, a change between growth and value. How, you know, growth has been outperforming, but that we might be getting into a sea change. If we look at what's been going on over the last 5 days, the dominant players in a risk-on marketplace are on the top. Consumer discretionary, technology, financials, and financials are down 2%. Consumer discretionary is down 1%, and tech is basically flat. Now, this is generic, all things considered, right? Because chips, they're really big. They're not here. And tech is so generic. It doesn't cover things like specifically cloud computing or advertising. So, you know, it is generic, but we can see that rotation out of the dominant growth spaces. But if you look at value, you know, staples still hasn't come up all that much. Healthcare, sure, it's looking better, but only after a significant beat down anyways. And utilities, I mean, more and more we're lumping utilities in with data centers and SMRs and tech because we need energy to run those data centers. So sure, utilities is still a staple, but you know, it's having a harder and harder time maintaining that discipline. So if we're getting a capital rotation, then we've got a nice start. The idea is whether or not it's going to stick. So I would look for this week to be the stabilizer. It's a short week, FOMC, you know, OPEX, everything else. It would make sense to see things just kind of hold the line and go into expiration and come out with new positioning afterwards. Miners are down, and really and VIX. That's it. Airlines, Mag 7, tech, finance, banks, chips, China, Bitcoin, nearly everything else, uranium, all of that is up. So on a morning like this, when we have that many sectors that are up at least 0.5% and none that are really down more than 0.5%, it doesn't hurt to look at what's in the middle and what still needs to join the party. So metals and mining, yeah, we don't really need that anyways for a rally day. This IGV doesn't really move that well in the pre-market, so we're not missing anything there. Home builders and biotech, we don't need them to rally. So yeah, I'd like to see a little more out of communications or something, but with what we've got up now, we've got enough to make a rally stick. And if we lose this rally that we've taken this morning, with all these things that are up, that would be a very obvious bad thing, right? If you got all these things in your favor, why would we be going down at this point? So if we do start breaking back through the levels, it should be a cause for concern at that point. We're well above VWAP. So if we get back inside of Friday's range, that's the first target. Get back to VWAP. Then look for reciprocation of VWAP. So just measure whatever we had on top, plot it to the downside. And after that, it's level by level all the way back down to the daily floor pivot and then some. We should not break back down through VWAP, right? Not with everything that's in our favor this morning. So if we do, it would stand out, right? Significantly. And VIX gave it up. So we're still above that magical historic level on the VIX. If we get down below 19, then sure, we can take more risk off the table. But VIX above 19 still holds us in a risk mode. So we're bullish. We've got all these sectors that are up this morning. The VIX is saying proceed with caution. We want to see this get below 19. Just there's some minor levels in there, but big picture focus, get this thing back below 19. If it's still above 19, then there's a risk that things can go sideways and we start to fail and unwind and break back down through Friday's levels. Really? It should have did that already. For the 10-year, you can see the range. We're not at the bottom of it. We're not at the top of it. So the 10-year is not out of control. It's not testing highs that it shouldn't be testing, and it's not just breaking down and selling off into oblivion. So the 10-year is in a good, healthy, normal spot. We see that TLT is down, TNX is up, but not beyond an extreme level. So we're not going to get any help there. We don't want a rally day on uranium and pot stocks in China. So the fact that they're up the most is okay, I guess, because we still have hours behind it, but we need to keep it. So Bitcoin being up, it's a symbol of risk. That's good. And then chips and tech. So we want to see this broaden out. You don't really see much in the communications and cloud services until after we get into the open. So when we get into the open, check those two, make sure that they're coming in to participate, and then just keep the Mag 7. All things told, let's catch this real quick before we wrap it up. On FOMC week, it's considered volatility suppressing because generally speaking, on Monday and Tuesdays, we don't do anything as we wait for the FOMC event to get here, right? That's the general consensus. It's generally what we do. But there have been times in the past where we get an FOMC week and Monday and Tuesday, we just go in one direction, not necessarily up or down, but we make a move. So while most FOMC events are sideways into Monday and Tuesday, it doesn't mean that that's what we are going to get. And we've already started this FOMC up more than 0.5%. We're continuing to drive in the right direction. So if you go in and you find previous FOMC weeks, a lot like this here, for an example, where we were sideways waiting on FOMC for not just the Monday and Tuesday of the week of the event, but Thursday, Friday, Monday, and Tuesday in front of the event. It happens a lot where we just go sideways into FOMC, but there's plenty of examples where we start the week on the run and we run for Monday, Tuesday, and part of that Wednesday, up or down. I'm not taking a directional stance here. So don't discount the idea that just because it's FOMC and a short week that we have to go sideways into the event, because we don't. And that if we break out and we start to run, we could get one heck of a move. Kind of buy the rumor, sell the news sort of situation, right? Or sell the rumor, buy the news if we go down. It doesn't really matter. It's just front running or pulling forward FOMC. Say it that way. So, just be mindful of the levels and keep your bias out of it. With that, be careful, be safe. Watch your contracts if you haven't rolled yet. Get them rolled. I'll see y'all tomorrow.